society event of the term. We're delighted to have with us today Paul Diggle from Capital Economics. Now, Paul advises banks, hedge fund managers and asset managers on the state of the residential property market, not just the UK, but the US as well. And with this experience, he is in a prime position to give us an insight into what's happening in the property market. Now, it can't be denied that the housing market is a key issue for contention, with our recent GDP figures being heavily driven by rises in construction, by gains in construction, our current loose monetary policy stance, and schemes such as Help to Buy. It's only natural to fear the prospect of another housing bubble. But this property boom is not constrained to only the UK. For example, in its October 2013 report, the Bundesbank of Germany reported that properties in German cities may be overvalued by 5 to 10%. In December, existing house prices rose by 20% in Beijing compared to a year earlier. So there's no doubt that this is a key issue of contention. Without further ado, I'd like to hand you over to Paul.
Thank you very much, Akash, and good evening. My name is Paul Diggle. I'm an economist at the macroeconomic consultancy Capital Economics. I'd like to start by saying I'm very honoured for the invitation today, so thank you very much. So the topic I've been asked to discuss is, are housing markets in the UK, US and elsewhere on the verge of a new bubble? So the agenda, I'll start by briefly outlining what we mean by a bubble, say a little bit about how we might attempt to measure whether a housing market is caught up in a bubble. And then I'll run through developments in 4 important housing markets: the UK, the US, China and Brazil. Now I've chosen the UK because I think it's particularly relevant to many of us here today, the US because of its obvious global importance, China because I think there are a number of common misconceptions about the housing market there that I might try and debunk and flesh out in more detail, and Brazil because I think developments in its housing market are probably understudied. As I run through each of these countries, I'll be considering whether they're in bubble territory and whether the current or potential future states of housing markets there pose a risk to wider economic and financial stability. But first, please let me tell you a little bit about Capital Economics and who I am. Capital Economics is a macroeconomic research consultancy, which means that we supply economic research which forms the raw materials on which our clients' investment decisions, both real and financial, are based. We do not provide stock tips, we are an independent consultancy, which means we don't have outside shareholders, we don't have business and securities and other financial products, we don't have any conflicting loyalties. Now, the firm employs around 45 economists, which makes us bigger than the vast majority of investment banks' economic research departments. And we cover the economies of almost all developed and emerging markets, as well as specific financial markets, commodity markets, and property markets. And I hope you'll allow me to flag up that we have a graduate scheme, which takes in 2 or 3 young economists each year. And a potentially very interesting feature of our graduate scheme is that, unlike a number of economist positions in banks, for example, we do not ask for a master's degree, but rather pay for you to do a master's degree and support you through it through the scheme. The master's degree has usually been at LSE, and so I just advise you to check out www.capitaleconomics.com if you want some more details on that. Now, a little bit about who I am. I am one of 5 economists at Capital Economics working specifically on the property sector, and I cover the US housing market and previously covered the housing market here in the UK. I work primarily with asset managers and hedge funds who either own institutional quantities of residential property or who invest in stocks and financial products which are closely tied to the housing sector. Some of my clients are also regular mortgage lenders, and some of them are surveyors and estate agents as well. Finally, if you find this talk really interesting, please follow me on Twitter at Paul Diggle. Okay, so what constitutes a bubble? In essence, I think a bubble occurs when asset prices become divorced from their fundamental drivers, or some conception of their true worth. The most common trigger for this is when unrealistic expectations of the asset's future value drive a surge in speculative behaviour. And in a housing context, bubbles are not just limited to house prices, but can also include rents, construction volumes, and financial products tied to housing. An important issue is obviously how we measure bubbles, specifically in a housing context. In the stock market, for example, there are a number of fairly well-established, although still somewhat controversial, benchmarks of fair value, most of which are variations on some sort of price-earnings ratio. And I think that a similar approach for housing is suitable. So I'll be presenting comparisons between house prices and earnings, or house prices and rents. Okay, so let's start with the UK. In the UK, we are blessed, or perhaps cursed, with a wide variety of house price indicators. And while they move broadly together, you can see in this chart that they have differences in the way they are put together means they can sometimes give contradictory messages, and that's something that gets a lot of attention in the press. But the broad consensus was that UK-wide house prices fell by around 17% between 2007 and 2009. They remained broadly stagnant until 2013, and they've risen by around 5%, depends on exactly what indicator you use, over the past year. Now, a big part of the recent revival in house prices has been due to the government's Help to Buy scheme. By way of a brief summary, Help to Buy has two major components. The first to be implemented back in April was the equity loan component, whereby buyers of new homes bring a 5% deposit to the table, they borrow 20% from the government and the remaining 75% from a regular mortgage lender participating in the scheme. The loan from the government is an equity loan, which means that the government owns a 20% share in your house, and put another way, when you sell the house, as well as the capital, you must repay 20% of any increase in the value of your home. But equally, on the flip side, the government shares in any decline in house prices. And note also that the equity loan scheme carries a small interest charge, but only after 5 years. So it's interest-free for the first 5 years. Take-up of the equity loan scheme, this first component of Help to Buy, has been very strong. Around 10,000 reservations for new homes were made through the scheme in its first 4 months of operation, helping to explain the surge in mortgage approvals shown in this chart, on the right-hand side of the chart. And the scheme is well on course to reach its target of supporting 75,000 transactions over 3 years. But the equity loan component of the Help to Buy is potentially small beer compared to the next stage of government support, which is the mortgage guarantee aspect of the scheme. In exchange for a fee, the government will protect lenders from losses of up to 20% of the value of a property in the event it's repossessed and in negative equity. So the hope is that lenders, being largely protected from losses in the event of possession, will be more willing to provide high loan-to-value mortgages to borrowers. The government thinks that it could support up to 850,000 transactions in this way, including for second-hand homes. The first tranche of the scheme was limited only to new homes over 3 years. With transaction volumes in the UK running at 1 million a year, that's a potentially very significant increase in overall transactions. Finally, it's worth noting that there are a variety of other government schemes which operate primarily on the supply side in the housing market, for example, by releasing public land to home builders or providing funds to restart stalled housing projects. So together, the first stage of the Help to Buy scheme, which is targeted at new homes, and other government schemes supporting construction, explain the upturn in home building in the UK over the last year. Again, this is the increase on the right-hand side of the chart. Nevertheless, I suspect that the time-limited nature of Help to Buy will mean that lenders or builders are wary of expanding too fast for fear of demand dropping sharply in 2016 when the scheme expires. In addition, survey evidence suggests that home builders are increasingly encountering shortages of labour and materials. So we aren't expecting 2005-2006 levels of home building anytime soon. So let's turn to the question of overvaluation in the housing market. Now, I apologise for the change in graph format here. I've taken some slides from a presentation of a colleague, so he's used a slightly different format. So over the long run, you'd expect house prices to be anchored by both rents and incomes. After all, rents are a key determinant of the return that a landlord will receive on a house, and income not only tends to drive rents, but also helps determine what an owner-occupier can afford to pay for a property. However, whether we look at the house price to earnings ratio shown here in red, or the house price to rent ratio in blue, prices look very high in relation to these fundamental determinants of value. So to briefly explain the graph, the level of 100 is the 35-year average ratio between house prices and earnings, or house prices and rents. A measure of 140 is 40% above that long-run anchor. Now, one commonly heard counterpoint when presenting a chart such as this one that I'll hear regularly from clients, is that there's been a permanent shift in the sustainable relationship between incomes, rents and house prices in the UK. Many people attribute this to the UK's poor housing supply record, the fact that we are not building enough homes. It seems pretty clear to me that we do need to boost the supply of housing in the UK, but I think the scale and impact of our supply problems are generally overstated. In any case, while a shortage of homes would explain the gap between house prices and incomes, it does not explain why house prices should have risen so far in comparison to rents. After all, as housing is in short supply, its price, no matter if that's a capital value or a rent, should both have gone up, and that's clearly not happened. A much better objection to the argument for overvaluation is that prices are high relative to earnings and rents because interest rates are so low. Low interest rates encourage landlords to accept lower rental yields, and they encourage borrowers to take on larger mortgages in relation to their income. Indeed, as this chart shows, the past decade has seen an unprecedented rise in the size of the typical first-time buyer's mortgage. From an average of 2.3 times income in the 1990s, mortgage multiples have soared to around 3.4 times income today, effectively increasing a buyer's purchasing power by 45%. But as this chart shows, since around the year 2000, the previously good relationship between earnings and average house prices in the UK has broken down. However, the dotted blue line shows that relationship can be restored simply by scaling up earnings to reflect the 45% rise in households' purchasing power stemming from the rise in mortgage income multiples. Indeed, this adjusted measure of income seems to explain more or less completely why house prices rose to and have sustained such high levels. Another metric which we commonly present when talking about fair value in a housing context is affordability, which is the burden of mortgage payments relative to income. This chart shows that mortgage affordability in the UK is currently at or even slightly below the average level over the past 4 decades. So to explain this chart again, it's simply showing the burden of monthly mortgage payments, average monthly mortgage payments relative to average monthly income. And we say a long run normal level is just over 30%. So the conclusion I draw from all this is that in the short term, as long as interest rates remain low, the economic recovery gradually strengthens and the squeeze on real incomes eases, it's likely that high income multiples and favourable levels of mortgage affordability will continue to characterise the UK housing market, supporting the gap between house prices and incomes. But the argument I want to make is that surely this is a cyclical rather than a structural phenomenon. After all, when interest rates do rise, landlords will revert to expecting higher rental yields, and borrowers and lenders will find that such high income multiple loans look far less affordable. The upshot is that, with the high level of house prices primarily a reflection of the exceptionally benign interest rate environment, I am concerned that house prices in the UK are not at sustainable levels. Okay, so let me turn to the US. The housing crash in the US between 2006 and 2011 was deeper and much more complete than that in the UK. Prices fell by 30% peak to trough, the number of annual housing market transactions halved, and home building volumes dropped by more than 75%. But just as the crash was deeper, the recent recovery in the US housing market has been stronger. You can see on this chart that the year-on-year rate of house price inflation in the US has recently risen into double digits. And the US is also experiencing a reasonably strong recovery in transaction volumes and housing starts. So a central feature of the US housing market cycle over recent years has been negative equity. As I'm sure most of you are aware, negative equity refers to the value of an asset which secures a loan falling below the outstanding balance of that loan. And because of the depth of price falls in the US, combined with the small or non-existent deposits that many subprime borrowers put down on their homes during the boom, 1/4 of all properties in the US, all mortgage properties, were in negative equity at the worst point. That is a huge number, a huge share. Another very significant feature of the US housing market has been foreclosures. A foreclosure is the American analogue of a repossession in the UK. And as you can see from the black line on this chart, at the peak of the foreclosure glut in 2010 and 11, nearly 5% of all mortgage properties in the US were in foreclosure and waiting to be sold by banks, literally on the courthouse steps. Now, there are a host of reasons why foreclosures became, and to an extent remain, such a feature of the housing market in the US. One is negative equity, as I've said, which reduces the incentive of many borrowers to remain current on their payments, encouraging the defaulting on a mortgage. Another is the non-recourse system in many US states, which means that lenders' recovery is limited only to the collateral which backs a loan, so that unlike in the US, mortgage borrowers in negative equity cannot be pursued for the outstanding balance of a loan. That also gives an incentive to default, especially when you're deeply underwater. You walk away, and if you haven't put down a deposit, you lose nothing. And a third is robo-signing, which saw banks process foreclosures hastily and en masse, and it turned out illegally. But the really interesting upshot of all of this has been who the glut of foreclosures being sold by banks in auctions has attracted into the market. You can see in this chart that foreclosures and REO homes, where REO means real estate owned, and it's property which lenders own following an unsuccessful foreclosure sale. Essentially, these are homes that banks have sitting around on their balance sheets, which they're really desperate to be rid of. These two categories of homes fetched a significant discount from the already falling and low level of house prices during the crash. So there was a glut of cheap, distressed housing available in the US housing market. And you can see from this chart that as a result of foreclosures, tight credit conditions, ruined credit scores, wage constraint, the effects of the crash more generally, the home ownership rate in the US has dropped fairly significantly from a peak of 69% in 2005 to 65% today. Of course, the flip side of a falling home ownership rate is obviously a rising rental rate. So hopefully you can see where this is going. The combination of a 30% peak to trough fall in average house prices, a glut of foreclosed homes selling at a further discount from the already low level of prices, and an increasing share of the population seeking homes in the rental sector has created a very attractive investment opportunity for some. And what I think is really interesting is that the wave of investors into the US housing market over the past few years, taking advantage of this confluence of circumstances, have not been individuals but institutions. So private equity firms and hedge funds are currently huge buyers of US housing. Specifically, they've been buying single-family housing, which is what in the UK we would call detached housing. So multifamily housing, broadly speaking, flats, semi-detached houses, have long been of interest to institutional buyers in the US because having the buildings concentrated in one location means they're easy to manage and standardize, and they yield decent yields. But single-family housing has traditionally been thought of as being too expensive to warrant institutional interest, and has always been left to individuals, what in the US are called mum-and-pop investors, to sort out. All that has changed over the past few years, and you can see from this chart which shows the rising share of rental homes, which are single-family homes. And this is driven by these institutional buyers buying en masse thousands of homes out on the courthouse steps and transferring them to the rental sector. So what does all this have to do with housing market bubbles? Well, a number of things, it turns out. Firstly, there is the question of whether the sharp gains in house prices in the US, which are the result of strong investor buying, have pushed prices above sustainable levels. And I'll turn to that in a moment. But perhaps more interesting to my mind is how the institutional investment market is now just starting to evolve. That's because large institutional owners of single-family housing in the US are starting to issue bonds, backed by a stream of rental income accruing from their property portfolios. In other words, we're seeing the re-emergence of securitization, but this time in the rental market. And that should, of course, arouse immediate suspicion and set off alarm bells, given what happened in the mortgage-backed securities market over the past decade or so. I think there are two interpretations of what this REO to rental securitization trend means. The first is a very positive interpretation, which says that this is an important funding channel, which is providing homes to Americans who want to or have no choice to rent. And it's a welcome recovery in the credit sector, and it marks the future, the evolution of the housing market in the US. But I'm minded to take a much more cautious approach, seeing the worrying parallels between REO to rental securitizations and mortgage-backed securities. After all, we have the same dubious AAA ratings being bestowed on many of these bonds, which is incredible to see the likes of Moody's dishing out AAA ratings to securitizations so soon and so freely. We have question marks about how secure the rental income is, given that renters have no stake in their home, no skin in the game. Arguably, they're more inclined to default. And we also have comparatively low yields on many of these bonds, which nevertheless remain attractive because we're in a yield-starved environment. So essentially the point I want to make here is that when talking about areas of the US housing market which look frothy, this new REO to rental play is a prime candidate. But turning to the more conventional question of the level of house prices in the US, this chart shows the amount by which house prices are above or below a 35-year average relative to rents and earnings. These metrics suggest that housing is at best still 15% undervalued in the US and at worst only fairly valued. This chart is essentially the analogue of the one I showed you for the UK, but done in a slightly different way. So we're showing you the percentage deviation in the ratio between house prices and rents, or house pricing and earnings from its long-run level. And that's meant to give you some indication of fair value in that market. Meanwhile, the National Association of Realtors, a state agent organisation in the US, measures housing market affordability and suggests that a family earning the median income currently has 170% of the income necessary to qualify for a mortgage on the median-priced home, which obviously is a mark of strong affordability. We've estimated that typical mortgage payments in the US average 17% of median income, up from their level 6 months to a year ago, but down from the long-run average, which is 22 or 25% of income. And even accounting for the increase in mortgage guarantee fees in the US, and these are the fees charged by Fannie Mae and Freddie Mac, the government-sponsored enterprises which stand behind the bulk of US mortgage lending, and which charge a fee for that service, which they've been increasing quite significantly in recent years. The total burden of mortgage debt in the US is close to an all-time low. So, concluding my remarks on the US housing market, I'd like to note that with a much lower starting point for house prices than the UK, and the predominance of a 30-year fixed-rate mortgage compared to the very short-term mortgages that we have in the UK, the US housing market looks much less vulnerable to the inevitable increase in mortgage rates. So the importance of the 30-year mortgage means that even when interest rates increase, you'll be locked into a cheap mortgage for 30 years, insulated from the increase in interest rates. Okay, so let's turn to China and on to Brazil. I have to admit that these are markets that I know less about. I don't cover day to day, but people within capital economics do cover them. And so a lot of the charts I've got here are taken from their work. So the mainstream view of the Chinese property market is one which is very much in bubble territory, and which has seen so much so that the government has had to introduce a suite of measures, including raising down payment requirements, restricting the number of homes that people can own, and increasing capital gains tax on property in an attempt to cool the market. I'm going to try and finesse this arguably oversimplistic view a little bit. You can see from this chart that comparing house prices with incomes in China, prices across the country as a whole do not look overly stretched. They're comparable to still expensive markets in like London and New York. But in individual cities, they look extremely high. In Beijing, the average worker would have to hand over 24 years of pre-tax income to buy the average house. In Shanghai, they'd have to fork out 18 years of income. But look a little closer and things aren't quite so alarming even in these cities. Much recent development building in the Chinese property market is focused on high-end properties where margins are higher and rather than providing housing for the average household. And because of the relatively poor quality of the Chinese house price data, these changes in the type of property sold have skewed the house price indices to an extent that's arguably misrepresentative of an average house. So one clue to the high-end distortion is the generous size of new homes in China. It's reasonable to expect new properties to be on average larger, especially given how cramped some of the older property is. But the average property built in the past 10 years in China measures 110 square meters, nearly double the size of the average existing home. Indeed, new Chinese homes turn out to be a quarter bigger than homes in Korea and Japan, in contrast to the usual pattern you'd expect to see of a poorer country having smaller homes. So the comparison between average selling prices and average incomes is, I'm arguing, very misleading. The average family was never the intended buyer of new homes being built in China. So compared to the income of the top fifth of households, house prices, you can see in this chart, house prices do not look out of line. Moreover, these estimates are based on official income data, which almost certainly underestimates the income of the Chinese income distribution. In other words, they still understate housing affordability. Finally, whatever the appropriate comparison relative to incomes, there is the fact that incomes have been rising faster than house prices for most of the past decade, a fact is often missed in the debate about Chinese property that occurs in the newspapers. So property has been getting more affordable at the national level. So I think the upshot from all this that Chinese property is not in a bubble in the sense of having prices which are too high. However, the other part of the housing bubble debate in China concerns house building. It's often said that China has already built enough property, more than enough property, to meet its needs. We've estimated that 93 million new urban properties were completed between 1997 and 2011, which is the equivalent of the entire housing stock of the UK, Germany and France combined, or 2/3 of the entire housing stock in the US. However, the net increase in housing has actually been much smaller than this. Assuming a 30-year lifespan for the average home, which is standard for China, approximately 40 million urban properties would have been demolished in the same period, making for a net increase of 53 million homes. And that compares with a rise of 43 million in the number of households with urban residency rights over the same period, as well as a very significant increase in the urban population without residency rights. In other words, construction in aggregate has probably only been just about sufficient to keep up with the growth in the urban population. And note from this graph that urban areas of China have just over 20 square meters of residential property per person. Other economies in Asia, including Japan, Korea and Taiwan, have significantly more. The conclusion is that China still needs to build significant amounts of property to bring the living conditions of urban residents up to levels in other economies. Yet even though China has built barely sufficient amounts of property over the past 15 years for its growing urban population, there is a worrying amount of empty property in the country. And this, in my opinion, is the real nub of the housing bubble in China. And there are two parts to the problem, or two causes of the problem. The first is growth in developers' inventories of unsold homes. The recent increase in inventories is due to a slowdown in sales and an increase in supply. Sales have slowed thanks to government controls, while the increase in supply is a legacy of earlier stimulus packages, which only now are filtering through into a surge of completions in China. And the fact that these new homes are largely targeted at the top end of the market explains why developers find themselves unable to sell their stock, even though there is plenty of unmet housing demand. A second source of empty property is the practice of speculative buying. Around 1/5 of urban households in China own more than one property, which are typically left empty and function as a savings vehicle for the cash-rich who lack other investment options. As well as being an extremely inefficient use of resources, the widespread use of property as a speculative investment is destabilizing. Most empty apartments were bought as long-term stores of value, but with a relatively thin secondary market. After all, 2/3 of all property sold last year in China was new build, and their resale value is unclear. And given that Chinese property has a lifespan of about 30 years, the value of many of these properties is probably depreciating fast. For now, these owners have few attractive alternative investment options, meaning that some very recent modest falls in house prices in China did not trigger significant selling. But as China's financial system develops, capital controls relax, and more investment options appear, the presence of this overhang of aging empty property could lead to a rush for the exits. So the final market I want to consider is Brazil. The jump in Brazilian house prices over the past few years has split opinion. Some argue that the rise is justified by the improvement in economic fundamentals in the country, population growth and strong wage growth, while others argue that it's a bubble waiting to burst. Like China, housing market data in Brazil is pretty sketchy, but we can put some figures on the recent boom. This chart shows that house prices in Brazil's 7 most important districts increased by around 25% in 2012, the latest year for which we have halfway decent numbers, and prices appear to have more than doubled over the past 4 years taken together. House price growth in Brazil has no doubt been supported by its booming economy and demographic pressures stemming from a growing population. The key question, however, is whether prices have risen beyond what might be justified by the evident improvement in Brazil's fundamentals. So with the caveat that the data for Brazil is ropey, I think that it's difficult to escape the conclusion that a rapid increase in house prices in the country has gone too far. For a start, the rise in house prices over the past few years looks out of proportion to the rise in income. This chart is our attempt to construct a house price to income ratio for Sao Paulo and Rio, which obviously has a very, very short history compared to the ones I presented for the developed markets earlier, but which is a virtue of the lack of house price data, meaning that it's difficult to draw conclusions about valuations. But it does clearly demonstrate that house prices have increased at a far faster pace than incomes in recent years. And we find a similar picture if we compare rental yields in Brazil to the emerging market average, which is what this chart does. Of course, the structure and nature of housing markets across the emerging world differs greatly, but comparisons with other markets do help put the rapid run-up in Brazilian house prices in perspective. 3/4 of major emerging market cities have house price per square metre of between $1,200 and $3,200. In Sao Paulo, prices are 20% above this upper bound and still rising by 25% a year. So my best guess, my opinion, is that Brazil is in a housing bubble and does have an overvalued housing market, and the extent of that overvaluation could be between 30 and 50%. Okay, so let's draw some conclusions and say what this all means. So I want to say a few words about how I see this playing out over the next few years. In the UK, despite the risks, I do not expect a new countrywide house price boom to develop. The first stage of Help to Buy has certainly had a stimulatory effect on the market, but the second stage looks less attractive to borrowers. I said it was potentially much bigger, but it's less attractive because it carries a commercial rate of interest, unlike the first stage, which is interest-free for the first 5 years. So we expect it to be a bit of a come to nothing and it won't achieve that kind of uptake that the government hopes for. And if a boom did start get going, the Bank of England has already signalled that it would be prepared to act. An obvious and sensible first move would be to recommend the scaling down or abolition of Help to Buy. And I think the Bank of England has the tools necessary to rein in a housing bubble and is prepared to do so, unlike in the past. Nevertheless, a medium-term concern for the UK housing market is its worrying dependence on low interest rates. In the US, as I've said, I do not think that prices are on the verge of a new bubble. The biggest cause for concern there is the dependence of the market on investment buyers. As and when their interest declines, there is a clear risk that the mortgage market will not have recovered sufficiently to allow your ordinary owner-occupiers to support transaction volumes to fill the gap left by retreating investment buyers. Related to that, the trend for REO to rental securitizations could well be another time bomb. And I think a lot more hard thinking has to go in what this REO to rental securitization process means, and whether we're just walking down the same path again. In China, I think that enthusiasm for speculative property investment is going to wane as other investment options open up, and there is additional risk that continued growth in the number of empty properties will ultimately cause a sharp price fall when owners try and realize the value of their investments. So if, for example, property investment as a share of the Chinese economy dropped by half, which looks quite reasonable and looks like a sustainable level relative to the amount of overbuilding in the top end that's going on now, it would knock off a full percentage point from China's GDP growth. Finally, in Brazil, the country's ability to register relatively strong rates of nominal GDP and income growth should make it easier for the housing bubble to deflate slowly by an adjustment in real prices. But any downturn in the real economy could rapidly translate into a sharper housing market correction. For example, a sharp fall in commodity prices or a fresh global crisis, possibly emanating from the Eurozone, are key risks in this regard. The good news, though, is that Brazil's banks look relatively well capitalized and should be able to absorb even hefty mortgage losses without taking a huge hit to Tier 1 capital. So that's all I have to say. Thank you for your time and attention, and I'd like to hand back to Akash and open up for questions.
Thank you, Paul, for the very insightful presentation. We have time for a few questions. You might have one start.
For the UK housing market, as you said, it's not the scheme terminated in 2016. Will the government mortgage guarantees continue after 2016, or will it stop?
Yeah, so those who have the scheme in place or working for them will be able to continue on it, but it will be closed to new in 2016. And that's why I sort of argue that timing in nature is going to build a caution when it actually does end up a sharp drop in demand. Now, of course, there's possibility to go on sites to extend the scheme potentially it seems to be popular and open. So it's that scheme running on and on, especially the scheme the important crux of the housing market. I think that's a feature of the UK housing market in recent years has been government's willingness to support it and inability to accept the correction in the long run to be more beneficial. So you could have house pricing extended feature.
You mentioned that Chinese houses or Chinese properties only have a lifespan, so to speak, of 30 years. What is the fundamental reasoning behind this, and if this was to be improved, would that help the fundamentals of the property market in China?
Yeah, so the reason is simply the build quality, difference in build quality, and the opening up of fresh land, flattening aged housing, replacing newer housing. An extension to the lifespan of Chinese property will increase the overall stock, especially given the shortest lifespan are those occupied people lower down the income spectrum, which I think where the biggest sort of shortfall in property is. So yes, an increase in build quality will certainly, and lifespan will certainly help to address some of these issues, but that's going to happen so slowly. There's such a slow period that it's difficult to see of institutional ownership of housing in the UK is a very interesting one, because unlike in the US, where institutions have traditionally been interested in big apartment blocks and now being interested in detached housing as well, in the UK there's very little institutional ownership of the housing stock. And the government doesn't like that and wants institutions to start buying housing and renting out. And they think that institutions can make better landlords, they would standardise process, they would improve the quality of rental property, they improve the tenant experience, that kind of thing. And they would also bring important sorts of capital into the housing market, which would encourage building as well, and would solve some of these problems of undersupply that some people think we have in the UK. Unfortunately, I don't think it's going to happen at this level of house prices. So the simple fact is that most institutions know that housing in the UK is very expensive, and whether it's going to happen very slowly by an adjustment in earnings or very quickly by a drop in prices, either way, if you ask them honestly, without allowing them to get out to their clients, even a lot of home builders and mortgage lenders will tell me that they think housing in the UK is expensive, so they're not interested in investing in it. And that also means that the yields are very low on housing and the average management costs. People think that tenants in the UK demand a lot, so a lot of management costs from that as well. So I frankly cannot see it happening in the UK and in a number of European markets simply because of the level of house prices. The reason it's happening in the US is because house prices fell so far, too far, the asset cheap and open up that opportunity.
That's sort of coming back to the question about the Chinese market. Because we've got the 30-year expectancy. How realistic do you think it is that the sort of replacement will happen after when it's due? Because I come from one of the post-USSR countries where we had the same issue of many properties being built for 40 to 50 years past. And they are sort of falling apart, but not quite. But because of the scope of the phenomenon, it's just financially impossible to redo them all. And what we're trying to do now is develop renovation, so that sort of building the facade a little bit. But even that is really very, very sort of slow and inefficient and requires a lot of government plans. How reasonable do you think that something like that will happen in China?
I think it's pretty reasonable in China because of the scale of the growth of the urban population and the sort of continuous demand for accommodation in urban centres in China. So I think the demand is there to renovate, rebuild, downsize again, whatever these homes. So I would be reasonably hopeful it will happen. I suppose a big thing that happened in China and USSR countries as well is that the housing stock has only recently been in owner occupation. It was previously state-owned or owned by your employer and was then, China and the USSR, sold en masse to the tenants, which explains the very high home ownership rates in China and in ex-Soviet countries as well. Extremely high rates, about 80%, much higher than in other markets. So, in that sense, there are people, and there's therefore a developing culture of home ownership, so I think that adds to the demand for homes in urban centres as well. So I think there is going to be renovation, and there's also no shortage of investment capital in China. A few outlets for it, that's why it's all come over here and more cheap credit. So I would expect to happen, sort of renovation like we're going to happen.
What would that come from a government initiative or from private?
So my understanding is that house building in China is mostly done by private companies, and the government has been at various points trying to encourage and discourage them. So I think the money is primarily private.
So the housing prices in the United States, in terms of the fall, vary greatly across regions, from the southwest to southeast being most partially impacted. Do you think that the sort of return of institutional investors, and you mentioned securitization of those products, rental products in those regions, is suggestive of speculation or sort of a bubble versioning within those particular contexts? Because as you know, in the Northeast and other parts of America, they were fairly insulated from the fall crisis, and they needed places such as New York or Boston to really notice the difference from 07 to more recent time. So within those particular regional contexts, is there evidence to suggest that sort of a new bubble is forming, as you pointed to, with regards to the crisis?
Yeah, so I don't really talk about specific states or areas, but it's a very good point that in housing, you'll always get people saying housing is always open, different things happening on different states, counties, different streets, whatever. So the crash in the US, for those who don't know, primarily happened in the West, and it was on sand states which suffered the most from the crash, and also became the cheapest, had the biggest foreclosure problems, had swathes of empty streets, boarded up houses, and those are also the ones where institutional interest has been strongest, definitely, because they were just the cheapest. And that has actually created bubbles in certain towns and even states, no doubt about it. So the classic example is Phoenix, where housing fell incredibly and institutional investors completely piled in, and there was a big glut of foreclosure at the start. By the end of the sort of cycle, foreclosed homes in Phoenix were actually saying that the premium to more homes, these are homes that are in bad condition, have been empty for a while, and they're selling a premium, which is ridiculous. And that was an artifact of the amount of institutional interest in them. So there are definitely markets that are more vulnerable to just the US business as a whole, and a lot of them are in some states.
As a brief follow-up to that, reciprocally, do you think in the U.S. there's sort of like a tendency to use like a sort of traditional investment grade products such as apartments and complexes as a way of sort of secure investment vehicle with no interest in actually retaining rental income, or as appreciation is figured to be safer there than would be in other regions?
Yeah.
Is there an uptake in that attempt?
Yeah, so that's another big part of this scenario trying to play, whether they're in for long term or short term, whether they're just trying to capture the capital gain, or they're in for long term. If you talk to them, they'll tell you they're in for long term, but they are selling these REO-oriented securities and spinning off their portfolio into REITs, real estate investment trusts, which are a tax efficient way of holding property for a long period and being a long term value investor in property, being content with the rental yield, not worrying too much about capital appreciation, not being desperate to sell, or wanting to make a 30% capital appreciation. That's what they'll tell you, and they told us. Now, which of those is true? I don't know. We're very interested to find out whether they are, in fact, operating some sort of pump and dump model, or they're in it for the long term. I think they're probably in it for the long term. I believe they say that, but I would be concerned that at the fringes there's a lot of people who want to sell once they've seen sufficient amount of capital appreciation. Definitely, so it hasn't just been institutional investing in US housing, it has been individuals as well, to a certain extent, and I think a lot of them are looking for big capital uplifts and opportunity to sell at some point.
It kind of follows on from that question. When we were looking at various countries, and also the cities, it's rather well known that London and the South East has been seeing house price growth, whereas the rest of the UK has been stagnant. We saw Shanghai and Beijing compared to China and Malaysia different. New York housing is incredibly expensive. I think in Detroit they give away housing, lots of happy meals. How useful do you think it is to talk about national aggregates and national housing rules when there does, as we mentioned before, it seems to be a regional issue?
Yeah, so that's a good question that we get asked quite a lot. Well, we are a macroeconomic consultancy, so we are naturally more inclined to talk about country-wide trends. And despite obvious differences in local markets, there are some very clear country-wide trends. So we think it makes sense to talk about national markets and then start disaggregating and talking about specifics as well. A lot of property commentators will say that rubbish. They have to talk about different markets, different streets even. But the problem with that is that it's very difficult to give any sort of coherent view of the markets. What we normally do, as much as what you've seen there talk about the national market and then talk about certain cities or regions. In the US research, write a lot about individual states. In the UK, obviously, the difference between London and the rest of the UK is a very big issue in housing. And I was just saying to some of the committee members before that it's potentially misrepresentative of what's really happening because the media commentariat are all in London. They're seeing their house go up, their children struggling for rental properties, and that very much affects their worldview. And so that gets an awful lot of attention. But you know, go to Newcastle, go to Bradford, you'll see very different things happening in the housing market. So it's important to talk about differences in different towns, cities, states, whatever, but don't overprepare either. It's a message we often tell our clients.
Yeah, my question is about the US market and about securitization in particular. So I think that securitization is not a problem as such. I think the problem is our treatment of credit risk. Because if you look at, say, the AAA rated situations of that I mean, there's a different from something that is based on fundamentals such as the 10 years old. Do you think that you can reconsider our treatment of credit risk and move to methodologies that consider fundamentals? Namely, chance of us avoiding the process based on securitization? Do you think it's not a big risk to that?
Yeah, so securitization is the evil in itself. It's not inherently bad, as you might say. It was the way it was abused so much during the boom, and potentially happening again now. The credit ratings, so called rating agencies, are big nonsense, and it seems just they're in the pocket. Well, this is all very controversial. They're in the pocket of people they're doing ratings for. That's how they get their money from high rating banks products. So they get a bad rating, they might not be able to do it again. They'll go to another guy to do it. And the other problem was that the amount of stuff that was securitized, the way it was done, and the way the underwriting was very bad, that you were saying people who bundled together and sold it on and therefore bought credit risk themselves to have no incentive to underwrite it properly, as they end up filling it with rubbish, essentially. So the question is that all going to happen again or not? The securitizations that are happening in the REO market are all pretty, it's still quite small relative to what happened at the peak of the MBS securitization boom. What I'm trying to point out to you is that this is the next thing to watch out for. And it could go either way, I think. I think you'll find a lot of people who are very dubious about the whole process and say that it's the same thing happening again, poor underwriting, poor yields, no skin in the game, this dubious process again. I think you're quite right, if it's done properly. Securitization is clearly a very helpful way to move capital from one place to another, to attract capital to a market that needs it. It is part of a properly functioning capital market, which gives you knows important for economic and economic growth. So yeah, just like all things, it's like guns that kill people.
Probably my question is more, should we move away from rating agencies to move towards sort of more internally based methods of fundamentals?
I think a lot of these issuers of REO transfers now are also being asked or willing to maintain a certain amount of risk themselves. They'll have the first 5% tranche on their books themselves, and then they'll sell on the rest and say, well, look, we're taking on the first 5% the risk ourselves. Clearly much more confident in their ability to underwrite properly.
To what extent has Kiwi affected climate trends in the last few years, and how do you expect it to affect in the next few years?
Yeah, so in the US, as we know, Kiwi is involved not just buying treasuries, but buying mortgage securities as well. So mortgage securities does exist in very large quantities, and the Treasury, Fed's been buying those from Fannie Mae and Freddie Mac, supporting continuing to support housing, creation of housing credit. So it's been very important because the Fed very important part of continuing the limited amount of mortgage credit that's continuing to be sold. It's also another big issue of QE is whether it has actually kept rates down or not. It's not clear. I think it's not conclusively proven whether QE has helped keep rates low or not. If you actually look at when QE open market operations actually occurred, normally bond yields have increased rather than decreased. So it's had a perverse effect. The issue now is when central banks wind down QE, how what sort of effect that's going to have on interest rates as well, and therefore housing markets as well. Our view on the US, certainly the UK, has been QE tapering down largely priced in, so the increase in bond yields is going to be fairly moderate. So tapering doesn't pose a threat to the recovery. That said, in effect, hedge fund inflation exercise last year, they signalled they would be tapering and didn't. It had a very big effect on the markets and interest rates, and it had a big effect on housing as well. So a lot of housing market indicators in the US dipped when rates spiked because of the Fed inflation. So I think it's been very important, and the exit strategy now is going to be very important as well. How well it's managed, what it's going to have on rates.
Okay, well, thank you very much for your time, Paul, and all the way to Cambridge. Just in terms of next week, we don't have an event next Wednesday, but on Tuesday, for those of you who are interested, we're having a Barclays Assessment Centre skills session. So if you want to be there, just email internalaffairs@marshsociety.com. All the details are on Facebook, and you'll probably get an email within the next few days for a newsletter. Otherwise, I hope you have a good weekend. For those of you who come for the conference, we've got big news that we have the Indian High Commissioner as well coming. That's just happened today. So for those of you who bought tickets, that's something to look out for. Otherwise, thank you very much for your time.